Hey everyone, this episode is brought to you by Avalanche. Everyone's favorite red coin is a fan of On the Margin, and we are a fan of Avalanche as well. Talked about it on the program before. Avalanche is a very cool solution. Their subnets allow for a very scalable blockchain that's also interoperable at the same time. And it's not just me. The institutions are noticing and they're building on the evergreen subnets as well. You're going to be hearing all about some of those institutions later in the episode. For now, Avalanche, thanks for making this possible. 12 months later, people were like, yeah, Suzu's a moron for saying supercycle, but we're going to have a meme coin supercycle. Don't mid-curve it. Like, how dumb are you? I'm sorry. That is, it's like, come on.
Starting spicy. Welcome back, everybody, to the Roundup edition of On the Margin. We just had to hit record right away because we caught Mike mid-rant, and it was awesome. But we're just tearing apart crypto here this morning.
I'm coming off a 2-hour podcast. I literally stopped a 2-hour podcast with Selkus from Sorry, and then got right on.
You just got on the Selkus. No wonder you're
I'm going into hour 3.
Up.
So we thought Biden did really well in the debate last night.
Yeah, what's the inside scoop? There's got to be a ton of intel.
No, he's a really actually. I know he's been popping off on Twitter, but I've always liked Selkus. We've known him for years. We did a podcast with him actually back in the day, and he was very well reasoned in terms of his strategy and his. I think he just cottoned on to the fact that it was politics was an existential issue for crypto in the U.S. before a lot of other people. And I'm not saying I 100% agree with his politics, like I don't, but I think he did do a really good job of raising the urgency level of the entire industry. So I think he was right. It's existential.
I mean, you just got to look at like what he's doing on his Twitter separate from like him as an individual. Like it's a strategy and it's effective, but it's just part of the game.
You know who people also, I would put him in a similar bucket as like Pomp, because Pomp sometimes rubs people the wrong way with his Twitter, but we've known him for a really long time and he's a super thoughtful guy. It comes across on his podcast, like really articulate, really intelligent, has his hands in a whole bunch of different pots. He's a good operator and investor, which is a really rare combination. So yeah, I'd put them in similar buckets, kind of.
This episode of On the Margin is brought to you by Pomp Investments.
Shout out Pomp.
Shout out Pomp. Look, guys, we've been starting the last few episodes by going pretty deep into the macro world, and we're still going to do that today. But I think it'd be great to just have a little reset and just level set on what's going on in crypto. We've been seeing it chop around and people are starting to go insane. Crypto Twitter is losing their minds, which is definitely a pretty good sentiment indicator of where we're at. But we had a couple interesting news points that came in this week too. We saw VanEck submit Solana ETF, which was really interesting. We're getting much more runway on where the ETH ETF is going to be launching in the next week or so. Some really good things are happening. We had the presidential debate last night, and Trump did quite well, which is obviously also positive for crypto regulation on the margin. So, I mean, a lot of good things are happening. And meanwhile, we're just bleeding out slowly and people are losing their minds and nobody's really, levering up that much. So I really want to pass it over to Quinn, who's been looking into the microstructure and just, catch us all up on what's been going on there.
Yeah, I mean, we've had basically a flat range for the last 3+ months since March. And, it's kind of developed how you would expect a momentum driven, market to develop, where in March we were going to 100K with no pit stops along the way. And April, we had a little geopolitical skirmish that put a road bump in it, but we're still, on the path. And then May comes and we get some relief. And now in June, it seems like all hope is lost as everybody that acquired Bitcoin from a governmental agency to, the GOX claims is now liquidating. So this tends to happen, capitulation and fear usually invoke a more short-sightedness. And I'm sitting at the position having gotten quite cautious in March and April, and seeing the risk reward, right? It's all a probability distribution, expected outcome analysis. And the newer market structure with ETFs, I think, also plays a big role into it. Volatility is way down despite being in the midst of this upward structural bull cycle. And so I think there's some of these under the surface elements. The ETFs, why that changes things is it dampens volatility where, similar to what I said about the Bitcoin ETF is going to be the same for the ETH ETF. if you're now analyzing 1 to 2, 3 days out, the ETH dynamic could create a negative surprise, but its pure existence reduces downside volatility. Whether the flows are 10 billion in the first year or 0 in the first year, they're not negative, right? The ETH dynamic, okay, you can argue, but that will be gone away pretty quickly. And honestly, the dynamics are more attractive than the GBTC situation. But on a longer time horizon, it can't be negative. And so that reduces downside volatility because you introduce a new avenue of capital and potential bidder. So, I just think as we're starting to, we had this growth scare in April and May. It started with a rate scare, then it was a geopolitical scare, then it was a growth scare. And we're kind of coming out of that. We're getting better inflation data that's showing Q1 might have been a blip. And I think September is very much in the cards. And then on top of that, the political environment is moving towards less regulatory overhang environment. And we have the ETH and some of these other things. So I just find it crazy that sentiment just gets so skewed in one direction. But, it's not that surprising, I guess, that things aren't rebounding super quickly, just given how hurt I think a lot of market participants were over the last 3 months. And those wounds take time to heal before you get appetite to relever.
I feel like it's wild just looking at this chart you put in the deck here, just looking at open interest. Like you can see that pain in here. Like we were ramped up quite a bit leading into the Bitcoin ETF. And that's just been all completely reversed. And, that's people either closing their positions or outright liquidations. And you can just see the pain in this chart. Like,
so what's this showing is altcoin, non-BTC, non-ETH open interest as a percent of total. And you can see in Q1, right, we were up to like almost 42% total open interest of futures leverage was alt, non-Bitcoin ETH. And we've retraced that just enormously back down to the lowest since mid-23 in terms of percentage of total. So, yeah, this is the time. I mean, we're hearing a lot of, I think, people that will, in hindsight, be seen as late to the short alts party here if you're getting super bearish right now.
I agree. I think that, we can talk about some of the macro stuff as well that's supportive of Bitcoin. I was a little bit surprised last night that Bitcoin didn't do better off the back of that rally, or off the back of that debate, sorry. Because, we could talk about this a little bit. I know this isn't really a politics show, but there was a clear winner of that debate to the point where even people who are, the CNN commentators right after that debate, the first thing they asked was, is Biden going to get replaced? So I've got no political edge there. I don't know if that's the case, but I do know that he lost that debate. And everyone knows that. I think if you're betting on a Trump presidency and you're looking for exposure there in one way, shape, or form, I think crypto is basically the purest way to express that. But I think in the meantime, maybe could this just be that one of the headlines that grabbed people's attention this week was the selling of Bitcoin from the US and Germany. So there's something like a combined 5,000 worth of Bitcoin sales. More was moved to like the wallets on Coinbase. And I do feel like, especially around, no one wants to get dumped on by the government, right? So I sort of feel like that explains a good portion of why Bitcoin's been relatively flat here, because I feel like the amount of good news is stacking up. But what do you guys think?
There's one other dynamic that I think is absolutely enormous here that people are just starting to get to, which is the Bitcoin miner selling. And there's been deals behind closed doors for the past couple months where, clearly Core Scientific, basically what happened, let's simplify this very easily. They are now taking a piece of their compute capacity and allowing AI type companies, CoreWeave, to essentially pay them for that. So if they were making 6 cents per kilowatt hour, I think it was CoreWeave was like 12.5 cents. So they immediately doubled their profitability. So I'm getting to the point is essentially they're taking some of that Bitcoin mining capacity and they're way more profitable selling it to AI. Now this happened with Core Scientific. Hut 8 did a deal with Coatue to essentially take some capacity to AI. Then I believe BTBT, Bit Digital did the same thing, and then CleanSpark just did a deal yesterday. So what's happening is the capacity for Bitcoin mining is going away, and how much of that Bitcoin selling was to build out, the AI infrastructure to essentially sell high performance compute to the AI guys. Now, this is a bigger, larger thing that's going on, which is it's the battle of centralization versus decentralization, right? And the inputs, they need electricity, they need high performance compute. But how much of that Bitcoin selling was the miners selling to build out, use CapEx, use money from selling the Bitcoin to essentially plug into this new economic system in AI. So I think that was probably a lot of it. And now here's the funny thing. Those miners that are now transferring to the AI compute capacity, they were the ones that would mine like an oil company would mine and immediately sell it into the market. And the ones that are hodlers, which is like Riot, Mara, and those are the big ones, they actually are not doing the high performance compute deals. So the ones that were selling into the market are not selling anymore because, or theoretically shouldn't sell because they had better economics on high performance compute. So it's almost like at this exact same time that the macro might be turning, the incentive to hodl is actually getting better. So that incremental supply from the Bitcoin miners potentially could be going away here. So there's a lot of these unknown unknowns are now becoming known in Bitcoin. And, if we get a weak dollar, if we get lower rates, I mean, this has the potential to really turn up again. But, we need the market to heal itself a little bit.
Hey everyone, this episode is brought to you by Avalanche. Avalanche is a leading network of blockchain which is giving access to some of the world's largest financial institutions to experiment and build on crypto rails. I'm a big fan of Avalanche. I've talked about it on this program before. The Subnet architecture leverages some of the best parts of IBC over in Cosmos, the interoperability protocol, and the rollups on Ethereum, with the result that if you're a financial institution, you can build on something that's highly interoperable, but also customizable and scalable. And it's not just me. Many of the largest institutions in the world are taking notice. And a couple examples of folks who are building on Evergreen subnets include Onyx by JP Morgan's. They leveraged an Evergreen subnet to explore how tokenization can revolutionize the asset and wealth management industry. Citi and the DTCC digital assets are testing private market tokenization on the Avalanche Spruce testnet with Wellington and Wisdom Tree. So again, some of the largest financial institutions in the entire world are building on Avalanche. Avalanche Evergreen provides a suite of institutional blockchain deployments, customizations, and tooling designed to address company-specific and industry-wide requirements for financial services. So join the institutional investors that are choosing Avalanche today. Go to avax.network/evergreen. Again, that's avax.network/evergreen and join the revolution. Avalanche, thanks very much for making this episode possible.
Yeah, Felix, go to that slide on right after the one we just showed, and you can visually see this, which is the chart of network hash rate for Bitcoin. And this is showing in real time what Tyler just described. And this is basically miners going offline because of a lack of profitability. And this AI kind of arms race has infiltrated Bitcoin mining to the point where Bitcoin miners can go compute for AI at a 2 to 4x higher profitability than they can to mine Bitcoin. So this is making, on the margin, miners shut in machines and switch it over to a more profitable venture. And over time, Bitcoin miner profitability is still pretty low, but over time, as this equilibrium self-corrects, it improves profitability and takes seller pressure off. So I do think that's actually going to come into the forefront over the next couple of months.
Okay, let me share my screen here because I actually so this is a super interesting chart. This is the chart of, it was a little bit more zoomed out. This is Bitcoin hash rate, and it's also, you can see Bitcoin price. And people argue about this in Bitcoin circles all the time. What leads? Is it hash rate or price? And I'm here to tell you, price leads. Price leads, and then hash rate chases. And you can think about this just like this happens in commodity supply chains. When the price of a commodity goes up, people chase that and they bring more production online. They eventually oversupply it, and then the whole thing collapses. That's why commodities are super cyclical, period, like into forever. And something that happened, there's a big divergence you can see in between price and hash rate. That's not typical. Historically, that's been way more correlated. And what changed is miners were able to get financing, right? So that's why more and more hash rate was able to come online. And arguably the market was like way oversaturated. Like there was too much hash rate. And basically this was like one of the worst times in history for Bitcoin miners, because the way that Bitcoin works is there's this really elegant mechanism in Bitcoin's design called the difficulty adjustment. And basically when prices go down, people turn mining rigs off. Bitcoin actually like self-adjusts to a point where they give more rewards when there's less hash online to keep miners like having their rigs on. But because all of these miners were able to finance via debt, that difficulty adjustment didn't kick in, and people were just taking huge losses for a long period of time. So I don't know if this is what I actually think that the development of this sort of intersection with AI and miners being able to rent out some of their compute to AI should lead to less sell pressure from Bitcoin miners, because one of the other challenges is, and these business models have eventually gotten washed out. This is what Compass mining really used to do, but there was a cloud mining dynamic here that existed in mining for a long time, which was, hey, I'm going to essentially pay for this huge fixed cost of a warehouse with utilities and all that type of thing. And you, as a little solo miner, right, you can just buy a little mining rig and you can set it up in my warehouse and mine. The issue is, at a certain point, that becomes profitable. People want to turn it off, but then these mining operations are still stuck with huge fixed costs. And that's when they dump their Bitcoin. When people shut their individual mining rigs off, and then they have to still pay for utilities, and then they have to dump all that stuff. So being able to rent out their computing equipment, which is basically a gigantic fixed cost that they have, into other more profitable areas, means that they're not going to have to dump their Bitcoin at the worst time. I actually think it's like a really nice self-balancing mechanism, right? That should lead to less sell pressure over time for mining up. But I'm also not an expert on this. So anyone who's a miner who's listening is like, hey, dude, you don't know what you're talking about. For the love of God, hit me up. But yeah, that's my thought.
We're not experts either, but what I can say is the cost of capital should drop for Bitcoin mining because of this
Yes.
thing, right? I think that's what you're saying is, Hut 8 raised $150 million from Kotu in a convert, I think, and you previously had to sell your Bitcoin, right? Like if you couldn't see equity in the equity market, you had to sell your Bitcoin to finance your CapEx build out and upgrade your machines. There's all this CapEx you have to do. And now you can just line up an AI deal at double the profitability. I mean, it really changes the dynamics, and people who are close to the Bitcoin mining sector, I think, get this. And I don't think this has made its way out into the ethos just yet. Maybe I'm wrong.
No, you're not. But Tyler, what a better point is that the cost of capital has come down than these guys getting all these huge financing. I mean, these businesses were literally unfinanceable for the last 3 years. Wouldn't touch them with a 10-foot pole. The only way they could maintain going concern was relentlessly dumping their stock in the market and tanking their share prices. And now they have top VCs coming in, giving them money. I mean, that display number one, that the cost of capital is coming in.
Do you guys remember last cycle when there was a lot of talk about how Bitcoin miners can help, with the residual of energy producers, and basically filling in that gap and leading to like an alternative source of revenue? I haven't heard about that at all this cycle. It feels like maybe this version cycle is talking about the AI synergies, but do you guys still hear about any of that? Because there's this idea of like it's actually going to be greener because with the residual energy, because they always have to be running, but they don't want to be producing energy, they can just go start mining Bitcoin instead.
That's 100% real thing, by the way. But just the dynamic of who owns Bitcoin mining today is what will change over time. So basically, the moral of that story is West Texas has a huge electricity glut because they have all this flaring natural gas and solar and wind. And then you go to places maybe in southeast or northeast that are more constricted on their supply of electricity, and the cost for consumers much higher. The argument is that over time, as Bitcoin mining becomes more understood and accepted and regulatory friendly, et cetera, every power company will, instead of flaring your gas and putting it out in the atmosphere, or letting your excess power go to waste, they will use it to do something like compute or Bitcoin mining. That takes a long time from an infrastructure perspective to actually build out in a way that is, cohesive with the grid. Today, it's just a bunch of kind of early crypto people that own miners in random parts around the country. But over time, I think in other countries that's being seen too with the different hydro. And
can I just plug Texas on the back of that? Like, Texas is the most diversified economy. They're doing Bitcoin mining. They have a $30 billion surplus, huge migration. I mean, California's got an $80 billion deficit. Just want to plug that real quick. Go Texas.
I get sad when I hear about Texas flourishing, because
Welcome.
the Texas of Canada is Alberta, and we did the opposite, and we just destroyed our energy sector, and now we have like a real estate Ponzi as our economy. So like, congrats.
Last cycle, I was saying,
for 3 years. But you might have to pay that exit Canadian tax.
I'm bullish Texas, Tyler, because imagine this. What puts an end to the crypto run, similar to 21, is when inflation gets out of control again and commodities are booming. So what do? You make a ton of money off your commodity production and you funnel those profits into crypto. And then it's just becomes this defensive portfolio, perfectly uncorrelated.
Dude, Tesla's here in Austin. We have Facebook, Google, like they all moved giant buildings in downtown Austin. I mean, it's a giant arbitrage. And if you want to stay in the coasts and have, I grew up in New Jersey. My dad was a teacher. He's getting, he has a great pension. And so essentially those giant pensions from the coastal blue states are just going to eat into the economic growth. Taxes are going to go up to pay those pensions one way or another. And all those companies, just like what's happening in Illinois, they're all moving here. And it's Florida too, but I think Texas is just like intellectual capital congregates. And I think especially like Bitcoin here, it's going to be the capital of the world. I mean, it is a lot of senses in Bitcoin mining already.
And they want to bring a stock exchange to Texas too, I saw. That's huge. That's a ton of capital trying to go in that direction.
If you think about, this is kind of meta macro, but New York was the epicenter of finance, and then it went to San Francisco during the zero interest rate years, where you had a bunch of crazy tech people create stuff when inflation was low, and now it's moving back to the center of the country. I feel like it goes back and forth, depending. Before 2007, 2008, New York was the hub. Then you had the tech boom, and now it's moving back in the center of the country. And I think that's just a fascinating thought there.
New York's done pretty well since COVID, though. I'm not gonna lie. It looked like there was an outpouring of. I guess I realize I'm the only one in New York, but yeah, I mean, for whatever reason, it looked like when we went into COVID, there was an outpouring of people from both New York and San Francisco to. I went back home and lived with my parents for a couple of months. A lot of people moved to Miami, people moved to Texas. And then there was a little bit of a correction there. And I feel like a lot of people moved back to New York, and New York feels like there's more stuff happening here than ever. I think San Francisco is the one that took the probably permanent hit.
Did you see that chart of software jobs in California? Just take an absolute digger.
I didn't. We can find it though.
You guys mind if I go on an inflation and monetary easing rant here?
Please do.
So this morning we had the PCE come in, and I'm really trying to focus these days. I had a really great interview with David Cervantes that aired this week, and one of his key points is just really focusing on the metrics that the Fed actually looks at, because there's so many metrics out there. But he's like, look, I keep it simple. I look at core PCE and I look at the unemployment rate. Those are the two key metrics that drives the Fed reaction function when you really, really boil it down. So we got the core PCE print today. Came in at 2.6%, which was in line with expectations. And you can see this is a great chart that just shows the different ways to measure inflation. So we have CPI, which is running at 3.3, PC, which is running at 2.6. It's been coming in consistently lower. A lot of that reason is because it underweights shelter inflation, which we're going to get into is really just the elephant in the room here. PPI has been, so producer price index has been running below for quite a few months now, and that basically trickles into consumer price indexes at a lagging basis because the producer input costs go into the final finished products. So that happened today, and more so importantly is looking at basically core X shelter, so super core of PCE, and after today's print, we're actually back at the 2% target. So that's really interesting to me, is that basically everything else is, like, dare I say, we're back at target if you look away from shelter. Now, every time like an inflation print comes out, everybody's like, oh, we're back. We're doing great if you don't look at this thing. Like, a year ago, it was like looking at lumber, something like that. So I understand that. But look, like if you look at every other component right now, the only reason we're not at target right now is because of the lagged nature and how shelter is measured, and especially like owner's equivalent rent. Like I've talked about this so many times. So if you look at the big inflation picture right now, we're in the last like 2% mile here. And so if you compare and think about what's happening on the inflation front, which is when you look at the core indicators that the Fed looks at, like core PCE, we're really, really close. And then what's interesting.
Sorry. I was just going to say the break 2-year break evens are saying the same thing. It's at like 209. Yeah. They've been punching on, forward looking inflation. So
that's a great way to look at because this is all lagging data, which is important to consider. So even the swaps in that market is saying the same thing. And then what's even more interesting is, okay, fine, like shelter is still leading to a sticky inflation. Okay, well, let's look at the leading indicators of shelter and housing. So U.S. pending home sales came in yesterday at negative 6.6%, and it was forecasted to be at 2.5%. So that's a huge miss. We're seeing pending home sales below the COVID bottom, below 2008. So sales have just basically frozen. And at the same time, right now is what we're seeing is that inventories are building up a lot. We have the most inventories of completed but unsold new homes in 14 years. So basically the only outside of that is the biggest real estate bubble in history, and when they're just building houses like crazy. So you have those two dynamics happening. So what happens, I wrote about this in the On the Margin newsletter that went out yesterday, is looking at how, the cycle of how this leads to lower housing prices and therefore lower shelter inflation and lower owner's equivalent rent is sales slow down, inventories go up. As inventories go up, I compared it to if anybody has tried to sell an NFT, you're trying to sell at a floor and then you're trying to capture liquidity, and then eventually somebody undercuts the floor and then the whole thing falls out. So you need to have that buildup of inventory and lack of sales to trigger that. So it feels to me like we're really, really close to that. And when you compare that with what's happening on the unemployment side of things is, we've talked about this previously about how the unemployment rate, the forecast from the Fed in their last SEP in the June meeting was 4%. That's where we're at right now. You can see here, we are at the year-end target. So with all the soft data we've been seeing, it would surprise me to not see this get above that year-end forecast. And then, the big question that we can get into here, and feel free for any of you guys to jump in on any of that, but it feels to me like we're really being set up for a pretty significant easing cycle. I don't see any reason why not. I would love to hear the contra side of all of that, but yeah, what's your guys' take? To me, it just feels like everything's setting up perfectly right now.
I would just like to actually give a shout out to these newsletters that you've been writing, Felix. Before a response to that, they're excellent. There's a lot of alpha that gets shared on the show, but I will say, very talented newsletter writer. And plug for the On the Margin newsletter that Felix and also
it's free, so go sign up.
Go sign up, baby.
Yeah. Can I also plug the fact that you're getting a CFA level 1 pass candidate? This is free access to a CFA candidate who just passed.
Oh my God.
Hear ye, hear ye.
We did.
Straight up.
You're gonna make me go red as a tomato in the face, Tyler, but I appreciate it.
Dude, it's impressive. I gotta say.
Thanks, man.
Hello, listeners of On the Margin. I've got good news for those of you who are in the crypto scene. Blockworks is bringing back permissionless. We're going to be doing permissionless 3, and this year we are heading west. So we're moving that out to Salt Lake City. That's going to be October 9th through 11th this year. We've got a phenomenal lineup of speakers for you. So we've got Balaji headlining. We've got Sriram, Munib, Matt Hogan of Bitwise, Jan Van Eck. This one's going to be a blast, guys. And I saw many of you out in London for DAS this year, and I hope to see you out in Salt Lake for permissionless. And because y'all are such faithful listeners, if you use code MARGIN10, you're going to get 10% off your tickets. Appreciate you all. Hope to see you out there.
On that point, I'm in agreement, and which is funny because like 3 weeks ago, I wasn't in agreement with you, Felix. I don't think a July cut is coming. I think that's too soon, and the Fed pretty much forever has given much more guidance towards their actions. But I do think a September is the base case at this point, and obviously the market believes that, but it's still far enough out where I don't think its effects are being that priced in. The thing for me has been that bond volatility, inflation volatility, all of these things have remained just extremely muted. I mean, we're seeing a little bit of an uptick today in the last couple of days in yields on probably the back of some of this Trump stuff. Winning pro-growth, that's should be a steepener for the curve, but a steepener of the curve for a good reason. Pro-growth, not a bear steepener. So, it is a bear steepener, but you get my point. I just think the market is kind of fully in this inflation isn't that big of a deal right now camp. I think we need to see oil and other commodities significantly break out, which I don't think is that doable with a strong dollar. So I think as the market digests the fact that, people are having a hard time wrapping their heads around the strong jobs with inflation moderating. But I think I take the Fed at their word. It's saying the economy's strong and we're restrictive. And so if the economy remains strong and inflation comes more in line, they can become less restrictive. It's kind of the playbook all the other central banks that have cut followed. Just it's not hey, we're kicking off this massive easing cycle. We're becoming less restrictive, and a lot of signs point to that. So I'd expect the rhetoric over the next couple of months to start reflecting that.
You know, the most shocking thing, there was a tweet last night that was great, which is Cuppy said, Harris Kupperman tweeted out, they said, how is the dollar not cratering on this debate last night? Because you're just watching, like, I don't know, it feels like the gerontocracy, like just coming to an end in a lot of senses. And the chokehold that generation had, that should tell you something. But secondly, Trump and Lighthizer have gone around and basically said, like, we need to reindustrialize America. You can't do that with a dollar that's at all-time highs, cutting off global dollar liquidity, where there's like sort of a burgeoning Asian crisis going on, and you need a weak dollar. So I'm really surprised the dollar's not just cratering today.
But look at long bond yields. I think that's where you're seeing it. Is those have been going up, and I feel like the biggest driver of that is the market pricing in like a Republican sweep and just the ensuing stimulus that comes from it. So I feel like you're seeing it in there, but maybe not the dollar.
That's what I think too, because the dollar's like you get some boost from pro-growth. If the people seeing Trump as kickstarting the economy, and you want U.S. assets, it's a harder one to. A lot more things going in.
Yeah, there's also this tariff dynamic where if they put tariffs on China, could you have that Chinese devaluation? I think maybe that's probably why. There's a lot of FX stuff. I mean, we're at some sort of turning point here in markets, and some things make me nervous. I could go through a couple charts. Something I check literally every day is this Asia Dollar Currency Index, and this has bounced off 90 3 times now. But if you go back, this is a really telling point. If we have a weak dollar policy, this should rally, and it should be salubrious for global liquidity. So this is something I'm watching closely. Also, there's another thing happening in France. Like if you look at chart 14, this is the French 10-year yield relative to the German 10-year yield. And it's basically saying, there's problems with France. The yields are rising there after the elections. And if you look historically, when those spreads break out in French yields, there's real problems with the euro currency. So I think that's another global thing that we're seeing here. Like look at the 2010 to 2013 spike. That was the European credit
crisis. Yeah.
And so you're seeing this this is a sign of like European debt stress. So something to keep on your radar here too, if the vault controllers can't kind of stamp that out. Then the last one to watch is slide 15. This is the JP Morgan FX volatility index, and it's kind of bumping up right on its 250-day moving average. And when this goes bonkers, like check out in 2020 when it, went up really, spiked. That's a sign that there's all sorts of crazy stuff happening in the globe. So watch these three things. I think at the end of the day, we'll probably get jawboning of Fed easing because of these. Because they're really, if they let it go, things could get really ugly really fast. So those are a couple of things I'm watching.
I think another one to an interesting chart is I'll just throw this in the chat here, but this one from Andrew Steno Larson looking at basically the tracking the US JPY to the 5-year real rates. I'll do my best for those that don't know about what that means, the 5 years, but it's basically the 5 years in 5 years, and basically it's the no arbitrage calculation between the two. But what that basically implies is it's a good reflector of the macro environment. So that and the yen have tracked really closely, and what we're seeing right now is just this pretty significant discrepancy between the two, and I think that's really showing that inflection point that we just talked about in terms of FX, where it feels like these moves are getting extended, because I think everything we're talking about right now is just, it feels like the dollar should roll lower, and that would cause this chart to kind of come back in line. So that, compared with everything else you're showing, it just, a lot of these, like we're talking about these like real-time indicators. I went through that rant looking at lagging indicators, but these real-time market data points are all pointing in this direction, that it feels like these moves in FX are getting to like their final moment before a shift.
I think the funniest thing about this, or whatever, most interesting, is that it's normally in these times where one sovereign's bond yields are doing one thing, the others are doing another. And it's kind of true, I guess, if you look at China versus the rest of the world. Chinese bond yields are the lowest, and they've had the strongest sovereign debt market, likely because they've been the most fiscally responsible in the last 3-4 years. They've actually taken economic weakness on the chin versus just printing a little more.
I don't know if that's the case or if it's just manipulated because you can't go anywhere else. They keep the money.
It could be. Sorry. But it's really, the bond yields are a global problem. I mean, the France chart looks like the US yield chart, looks like the Japan yield chart, so it's really just we're seeing the fall of these global fiat currencies. And ultimately, we know how this game ends, right? I mean, no one's going to let their bond yield just shoot through the roof. And it's going to cause some volatility in between relative values between the dollar and the other currencies along the way. But when you look at all these assets versus stocks and real estate and crypto, those things are up. So it's this kind of what we talk about, is that masking of relative fiat weakening between every fiat pair, but continuing to lose value against risk assets.
Check out, on the risk assets thing, this is where this dispersion trade is so strong. Like implied correlation hit like 880 this morning again. But check out slide 14. This is from the Scott Rubner at Goldman, who is just, he's probably the best systematic guy on the street in terms of flow related stuff. July, it has the largest inflows. Well, not the largest, but a lot of the inflows of the year happen in July. So, which is pretty incredible. And that's a low volume. Everyone's on vacation. And now you get into the low VIX trading. So unless you get some fireworks geopolitically, this is where the Jem Carson money flows slowly back into the buybacks as the buyback blackout window goes away. Then you have inflows from ETFs. So you could theoretically see the market grind up here again after this little brief period of I guess, like volatility.
I have a thought on the dispersion trade in general, Tyler. I don't know what your most recent thinking on it is, but it feels
Mhm.
like one of those things to me where people have been yelling that the market's been more and more concentrated for a long period of time, but it feels like the type of thing where eventually that has to break, but it can go way farther than everyone thinks at the time. And I think the forces that led to a very non-dispersed market are still in place, and I would actually bet on that continuing for like some period of time. I guess it's sort of interesting to watch Nvidia and what's going on there. I actually have a theory for you guys. People think this is hot air, but I'm building some amount of conviction around like the crypto AI stuff, and I've got a little pet theory about that. But yeah, I don't know. I still see. I don't think anything's really broken here in terms of market dynamics. I think what we've seen historically, I think it's going to still
Keep
be in
going.
place. Yeah.
Yeah. I feel like it's just like this continued financialization of the world. Like I think
Yeah.
this was your slide, Tyler, of Nike, but I don't actually know what happened. I just saw that they had the biggest drop in like 20 years today. But like I see this. I see somebody posted on Twitter yesterday a chart of Walgreens, which is like people still use Walgreens all the time. Like all the like they gotta get their drugs and shit. And meanwhile, the stock is down like 88% or something like that. So you've seen these like real life uses. Like everybody still likes Nike and wears Nike. It's still a good brand, but the stock itself is just cratering. Meanwhile, all these hyper financialized areas like Nvidia are just going up only. And it feels like we're just getting so separated from how people live their day-to-day lives in some ways. It's pretty wild. Do you want to explain why you had this in here, Tyler?
Yeah, I think this is one of the most fascinating high level stocks to watch that no one really watches much anymore. But get this. In April of 2023, that movie Air came out with Ben Affleck and Matt Damon, which was like months between it made that peak high. And to me, that was like the pinnacle of globalization, where you saw at that exact moment, within a couple months, Nike makes a peak. Then you have, and now it's crumbling. At the same time, you have the debate last night, and it's on this giant. Look at this. This is a 40-year chart, and it looks like a giant head and shoulders where it could collapse. If this is the end of like globalization and baby boomer companies, like Nike would be it, right? It was outsourcing, it was slave labor, it's virtue signaling, all the stuff that like those two people embodied in that debate last night. It's fascinating this is having exact moment, at the same time. So I just thought that was really interesting to watch. And they lowered guidance is what happened today. And the other funny thing is, have you ever put on a pair of Nikes recently? It's a dog crap product. Like I don't
I've
even buy.
always thought that about Nike shoes. I've got like collapsed insoles. I've never found Nikes to be. They always look cool. I always thought they were cool, but they aren't good
Yeah,
shoes. I don't think.
they
Is that a hot take?
valued it so bad. But like, I mean, everyone. I wear no bulls now, which is like better constructed. But when you grow this long, a company this big for this long, like you end up devaluing the crap out of the product. It's pretty amazing what they did anyway, just off the back of like nailing secular sports. And I also think the sports bubbles are popping on the back of this too. You see Stephen A. Smith getting $100 million. You see these like jokers that are like mid-tier NBA players getting $200 million contracts. But this stuff is a joke. Sports is in a complete bubble right now. And I play basketball, and I'm like,
You can dunk.
We
who
saw a
am I?
That's
video.
true. We've got
Dunk it
video evidence of that. Yeah.
at 40, still could dunk. But I think sports is in a bubble. I don't even like sports anymore. I like college sports is still pretty cool, but pro sports kind of stinks. Who goes
Look,
to
I
a
mean, I agree. So in my previous career, I worked in the outdoor industry in marketing, mostly in like ski resorts, tourism areas, a lot of bike companies, like the REIs or the Canadian version, which is MEC. That whole world, like I was working there when COVID hit and saw just this absolute surge. Like, everybody wanted to buy a mountain bike or something like that. And we had these huge shortages in mountain bikes, and everybody wanted to do that. This whole idea of everybody going out on their like mental health, like hot girl walk type things at lunch, all these ideas that like really ramped up then are in a complete reversal now. So say that like the mountain bike industry is just falling apart right now. Like there's just way too much inventory. Same with like, even just like outdoor toys, like snowmobiles, the snowmobile market, like they've had to cut their productions in half. So I totally agree. I think that entire world right now is just completely falling apart. And a lot of it was that COVID boom that kind of led to this final blow off. And then now we have like the bullwhip effect where there's just way too many inventories. And then people are just squeezed for discretionary like spending too. Like they don't have the money to be buying a new snowmobile like that, especially when financing rates are like, I think it was like 9% or something on those sort of recreational toys. So
I think it goes to Tyler's topics that you bring up around like who the role models are for society, because it's the same deal. It's like the average person can't even afford to go to a sports game anymore. You look at these concerts that are in stadiums with 75,000 people in them, and the entry ticket is $500. It's kind of one of those things that when you don't have to worry about anything else, you can drop that kind of coinage on all these luxuries. Like it's the definition of a first world problem.
Yeah.
And if your economy were to stumble.
Talk about dispersion like in society right now. Like I saw a chart the other day that TSA volumes hit an all-time high. So like the most amount of people are traveling right now. So it's basically like the upper class is just, they're killing it right now and they're sitting pretty. Meanwhile, the lower class is just getting destroyed right now from inflation, and the middle class just pretty much doesn't exist. You go in either direction right now, but the people that are doing well are traveling a lot right now.
It's true.
You know what sport though is not dying and it's on the up and up?
The NFL. The NFL still, you got to give it.
He's going to say pickleball.
Pickleball, baby. Shameless plug. But we're doing a pickleball tournament at Permissionless, and word around the water coolers that the guys Emporium is going to be a team out there. So yeah, actually, there's a little intra podcast competition at Santi and Jason are going to be a team over at Empire. So if there are people who are listening out there and are fans of the pickleball, come out to Permissionless. Join the tournament. It'll be fun.
You look like you got a good hand-eye.
I actually do. Yeah, I'm not good at sports, but like I've got pretty good hand-eye. I actually played Jason for in a game of ping pong for the title of founder number one time. This was at like an offsite, and we had a couple beers, and I actually changed my my LinkedIn title and then didn't log in for like 3 more years. And then one time, Yana was like a couple months ago, Yana was like, dude, what is your LinkedIn title? It was like Commander in Chief, founder number 1 at Blockworks. and I've been that for like 3 years. So yeah, but I like the racket sports. Racket sports are good.
Get your permissionless tickets before they go up in price.
Indeed.
Go. All right, well, maybe we can just do something a little different at the end here and just talk a little bit about either actionable trades or just final viewpoints for the rest of the year. Obviously, Quinn and Tyler probably just behind some interesting compliance things for how much they can actually talk about. But at least Mike and I can yell about certain things unrestricted. But I'd be curious, like, we talked about how September, the base case, we think is for cuts by then at the latest, in my opinion. I became slightly more worried after the June FOMC just because of how they're talking, what they did with the SEP, that it could lead to, if they weren't just trying to buy time and optionality and being slightly hawkish at that time, it could lead to this potential hard landing dynamic. I have a feeling that they will cut by September, in which case I still see it as like this bullish rate cut dynamic versus like a bearish rate cut dynamic that would occur if they do it too late. And they're basically trying to catch up to some sort of recession occurring. So that's how I view it. Other than the July meeting, we have the Jackson Hole Symposium that happens in the later parts of the summer. I feel like that could be a potential opportunity where Powell can signal this, unemployment is shifting at the same time that we've largely won at inflation, if you ignore shelter, and setting up that rate cut in September. But I'm curious, like, how are you guys trading that? What are you looking at? And what's your views if it's different from any of that?
I have a question for you, Felix, and we haven't talked about this, but hear me out. If let's say rate cuts don't happen July or September, they're not going to happen July, but let's say they don't, unless there's a really big problem. Mm-hmm. But let's say they don't happen September. Under that situation, you would say the expectation would be that the labor market is still fine, and you would probably say it's strong if they don't cut in September, and you would say inflation has been higher or stickier than expected. But it's very unlikely that inflation is going to go from where it is now at 2.6 PCE to 3.2 or something by September. So is it that bad if we don't get rate cuts for the right reason in September? Is it that bad is a question I would say, which insulates your margin of safety on expecting September rate cuts. I mean, it depends on how you're playing that expression and what you're betting on exactly. If you're betting on the Fed funds rate, then no rate cuts is going to be horrible for your outcome. But let's say risk assets, is it a huge problem for stocks, if the economy's strong, we get out of this growth scare and people realize that everything's fine, labor's strong, but inflation is just kind of flat instead of down. Is that a huge problem for risk?
Yeah, I guess not. I mean, that's what's so confusing about trading like an inflationary business cycle now, is that like typically, like say between 2010 and 2018, if you asked me that question, I'd be like, no, we'd risk deflation or something like that if like we're not easing in time. But now we're in this weird world where there's like we have higher nominal growth rates, and that can support growth, and that can support earnings growth, and then that can support equity growth. So even if we don't cut, there is still that dynamic at play. So I think it's a really good point that like it's a bit more complicated than what we're used to from the past 20 years. So yeah, maybe you're right. I mean, maybe that probability of a hard landing, I'm weighing too much if they don't cut in time because of that reason. Like we still have that deficit dynamic that's basically putting a floor on economic growth, like in keeping it high. So yeah, maybe you're right.
I just think they have enough levers here to pull, right? The SPR, there's still oil there. Prices aren't getting too crazy. Global demand is, commodities have been pretty tame, right? They haven't been like the April or August 2023. And obviously that can change, and that can change tomorrow, and we can go risk off if yields start spiking. It just seems to me that there's, the last thing going into election you can really afford as incumbent government here and how much inflation is coming up in debates and things is to let that get back heated up again. And I just think people might be overthinking it a little bit, right? Like we haven't had a rate cut we haven't had a rate change since October 22 or whatever it was when they stopped, or was it Jan 23, the exact date, but around
whatever
then.
It was, yeah.
So, it's been 12 months since we've had a change in rates, and crypto has tripled, and stocks are done, almost doubled. Like, so I'm just kind of confused what all this like doom and gloom is over when I see a pretty strong and healthy economy.
Yeah, I mean, I think like I'll just show one more quick chart here. But if you look at measuring restrictiveness using the Taylor rule, which like back before Fed funds was basically below the Taylor rule estimates, a lot of people talked about how we needed to go higher. But now we're seeing the opposite dynamic where Fed funds is above that estimate. So basically like they're very restrictive because inflation has been coming down. So I feel like that could be the only difference, is that if you look at like when we started to pause, there is that like decent lag time where you can see, my mouse isn't showing on it, but basically like there was that time where the Fed funds was pretty close to it. And that makes sense that we were able to hold high rates for so long without it feeling that restrictive. But if you look at it now and using inflation metrics from now, we're in a much more restrictive environment if you just look at the Taylor rule, which means that we need to cut. Like if you use the Taylor rule estimate, like we need to be cutting by almost like 200 basis points at this point. So I feel like that could be the difference, is that because of the lower inflation, we are a lot more restrictive.
I'm much less of an active trader than you guys, but so take this with a huge grain of salt. But I feel like now is the time to get bullish on crypto. I don't know. It just feels like everything is lining up for it. And yeah, I don't have any more complicated analysis for you than that. The sentiment is brutal. For folks who are listening to this that don't hang out on crypto Twitter, this is as bad as I've probably ever seen it. And whenever it's this bad, I mean, it's like the fear and greed index. It just, now is probably a good time to start looking at it again more consistently.
The crazy part is it's probably one of the best performing assets of the year.
Yeah.
even
It
with,
is the best performing asset of the year.
if you've been long it for the year, yeah, it doesn't really hurt that bad. But if you were that last couple months chase, yeah, it probably stings a lot.
That's why I'm such a big proponent of like managing your risk and then the returns come. I heard Santiago say that on the Empire podcast the other week and just totally agree with it. Like there's so many ways to blow up in crypto, but if you just hold on long enough, like you're going to do well. But if you chase narratives, if you were buying the top of the meme super cycle VC Twitter threads and you're just spreading yourself way too thin on those, you're buying these altcoins because you're too impatient to be able to sit. And even something like Solana, like that's going to do well eventually, but you're too impatient for that. So you need to go spread yourself thin on all these other things, and then you lever up too, and then you get liquidated. And even though the chart is from up and to the right, like your net worth is going in the opposite direction. And it's people need to manage their risk better.
I just trying to figure out, like, from a pure, like, zoomed out perspective, high level, we haven't broken new lows. We had yields approaching 5%. We had oil, 90 or whatever plus dollars a barrel, geopolitical war, and we didn't break. That was kind of the lows. We've had, the biggest supply overhang in the history of the industry has been Mt. Gox. We've talked about this for I don't know how long, ever since I've been in the industry. When is the Gox Bitcoin? We basically got the equivalent of all the Gox distribution selling in one day on Monday. And so that's gone. You have some government coins that occasionally move to exchange, but everybody that participates in crypto is well aware of it. I'm just trying to understand, like, I'm trying to reconcile personally what would break us down from here, given the array of positive catalysts on that. That's what I'm trying to answer. I don't see a good, to me, it's really just inflation coming back. That's all I can think of.
I think it's geopolitical. I think it's China moves on Taiwan, or China barricades Taiwan and we make a move, or it's, I don't know, some sort of credit crisis outside of the US. I think that's what you really got to be concerned about. That derails a lot of, like, global capital markets have been globalized. And if there's a geopolitical fissure in the market, you're not going to want to be in the centralized where everybody has been centralized. And I think if that doesn't happen, my read on the market is this can change. Obviously, it's like Stan Druckenmiller. You might ask me next week, it can change because you have to manage risk. You can't just have like a view. But I think probably what's going to happen is you're going to get an easing cycle. A lot of the smaller cap stocks, like check out like Carvana, like those are rallying somehow. There's a lot of stuff underneath that has built a 2-year base. So I think IWM does well, and you get that concentration of capital out of the queues, they ease. Because I think what you really did was the cost of capital doesn't matter for the mega cap stocks. They spew so much cash, they're incredible business models, and it really matters for the smaller cap stocks because a lot of them are not profitable. They're still trying to grow. They've cut a lot of fat. So if you have that cost of capital drop in the smaller cap stocks, that relative value might actually skew back and you get this massive influx from large cap tech. I think that's probably the next 6 months to a year play.
I totally agree. And I think that would, like, if I think about the max pain that, like, us included, all these like market podcasts have just been talking about dispersion trades and all that. So it's definitely the sign of some sort of top in that narrative. But I think like the most max pain way for that to reverse itself is just to see like small caps broaden out, and then just basically it just becomes this self-healing thing where slowly that capital rotates and small caps improve themselves as that cost of capital comes down, and the whole thing just kind of like mean reverts. I think like everybody's setting up for like a Volmageddon 2.0 and just probably buying VIX calls or something like that, and they're just going to get carried out expecting that to happen. But if we just like slowly see small caps come back up, like I could see that happening for sure.
I think that's what's going to happen. I mean, we've gotten to this point where the narratives are just so wrapped around the axle. I mean, for one, it used to be, oh my God, crypto can't catch a bid and NVIDIA is, and people equated NVIDIA to all equities and saying crypto's ruined, it can't bid when NVIDIA was an anomaly. The rest of the stock market wasn't moving. So crypto was in the rest of the stock market camp. And now that NVIDIA is stalled, it's not cratering, it's stalled, which is what happens when prices rise 3x in 3 months and people don't want to buy at that price. Capital rotates to another part of the market. And it's just super healthy broadening out. You have rate cuts, lower rates on the horizon. So I just think it's one of those issues of people saying like, oh, it's really bad that for crypto that it's not catching the bid with NVIDIA running. And then now it's also bad for crypto that NVIDIA paused, right? So it's like these arguments kind of just don't really add up. And for me, I do agree, Tyler, a geopolitical fissure or something is probably the biggest risk, right? With the stuff going on over in the Middle East and stuff. But depending on your strategy, that's a hard thing to invest around, given that unless you're a geopolitical expert. I just think it's relative value here is attractive for digital assets. I mean, if you look down the board this morning and you said, describe me the situation in markets if Trump wins, I'd say small caps outperforming, yes. I'd say yields higher, pro-growth, yes. I'd say dollar and gold, whatever. I'd say oil down because he's going to drill, baby, drill, increases supply. And the only anomaly I really see across the board is crypto. And it's like people forgot overnight that he's going to gut Gensler and the regulation red tape for this industry.
People don't want to bid anymore. Like, look at the funding rate in crypto right now for the past 2 months. Like, after we saw almost I think 100% annualized APR on funding rates after the Bitcoin ETF approval. We're about to get the ETH ETF approval, and just nobody wants to get in front of this. Everybody's just been absolutely decimated on leverage. That now we're just seeing this total, nobody wants to get in front of it. Nobody's bidding up leverage, and that's super interesting.
That's
I will
bullish.
Leverage.
That's just so bullish because people are buying dips. People are buying dips on leverage, and then they just got smoked and carted out. Yeah. And that's the type of stuff that you need to form a bottom. By the way, something else. This actually just happened today. The Chevron doctrine got overturned by the Supreme Court. So this is super. I mean, this was a 40-year-old case of Chevron versus the NRDC, the National Resources and Defense Council, and it was actually a unanimous vote at the time where basically a tie goes to the runner type thing. When there's ambiguous sort of rulings about what an agency can do, the government is going to defer to the judgment of a regulatory body, an agency, and that just got overturned today. And look, this is one of the, I think, something where I struggle with and hold two different positions in my own head. On the one hand, I look at what Milei has done down in Argentina, and he's stripped a bunch of the fat and bureaucracy out of government, and it seems to have gone very well. On the other hand, I'm just not a libertarian. I do believe that government has a function and that sometimes you do need strong leadership in government to step up. I think we're about to go through this big phase of taking power away from regulatory agencies, bureaucracy. You can just see it. This is what I think Trump is going to do. And that's not a permanent solution, but I do think that's going to happen and there are going to be some benefits. And look, the SEC has, I know this is a crypto person's opinion, but I mean, they've clearly abused their power here. And it's actually not just crypto people that feel like that. And so, yeah, the whole regulatory apparatus of the government has just had its boot on the throat of the industry for 2 years, and that's about to get lifted. And that's not the type of thing that you can trade on in the short term. It's not like rates, but it is impactful on a multi-year time horizon.
To that point, I think we're seeing demographics shift. Yesterday was really important, right? People are like, "Oh my God, we can't vote for old people anymore." Pretty much what happened, right? I mean, to a certain extent. And Musk brings up this point about Gulliver and the Lilliputians. I don't know if you ever know this, where all the Lilliputians are tiny little people put the ropes around Gulliver, and eventually, the giant just can't move. It's kind of like with the regulatory system. How many regulations have been added for 40 years? Basically, and I'm a strong believer in this, which is, I give boomers a lot of hate. But what they've done is they've really created monopoly type companies in a lot of these industries. And regulation favors the incumbent is one of my favorite quotes from Bill Gurley. So they've basically built up these moats with regulatory and red tape, so you can't do anything. And like to get into a market, you have a huge amount of capital, and so breaking those down demographically would really indicate a first turning, which is I think we're starting to see real first turning institutions, like come up, and regulation is a huge part of that. So this case might go down as one of the most important things that no one really cares about right now, but down the line, 10 years from now, when you get those look backs of what really happened, it gave you the regulatory reason to just like unwind a lot of those regulations. So I don't know. I think that's a really important thing for our generation.
Can I do a meme of the week? For you guys, there were a bunch of good ones yesterday with the debate, but this one just tickled me. This is
Yeah, that is so good.
sales and ops. That is hysterical, man. Oh my God. I guess it's a little bit of a niche reference, but it's like if you've ever tried to execute on something like an overzealous salesperson has sold, you will deeply feel this meme.
Oh my gosh. That's a good one.
I thought this was pretty good.
Can you throw, this isn't necessarily a meme, but can you put on slide 20 real quick? It's Bill Ackman. Obviously he was active Twitter. He was a former Democrat for years and years and years. It says, people very close to me, my closest family and friends, trusted the media on Biden until the CNN commentators finally owned up to the truth about Biden last night. For months, I've been accused by many friends and family of being misled by X, a right-wing echo chamber. Sad reality is this is one of the most important institutions, the so-called fourth estate, fourth only after the clergy, the nobility, the commoners, and has destroyed any remaining credibility it has. Consider your perception of POTUS Biden and real Donald Trump has been manipulated. The media can no longer save itself. I just think if you are not asking yourself at this point why decentralized media, aka podcasting, is way better than mainstream media, it's like the equivalent to me of the Catholic Church and the printing press. And I can't stress this enough. It's like the ways you're imbibing media are changing before our eyes. And last night was a moment that I think did more harm to CNN, even though it was pretty objective. It was actually quite well done, I thought.
Me too.
Yeah, me too. I thought they were pretty unbiased, honestly.
And it's easier for four white, middle-aged guys like us to. I'm not even like pro-Trump by any means. I'm just like, don't lie to me. And I just think this is a tectonic shift. Like if you're not asking yourself what the truth is at this point, I think things are changing right before our eyes, and it's really important to recognize that.
Yeah. There's a lot of reality checks going on in the world right now. And as these political winds shift, and it starts like the rubber meets the road. So, I'll have my little Canada moment here. But last week, we had a by-election in Canada where basically one of the strongest liberal stronghold ridings for the Liberal Party, like Justin Trudeau's party, has won there for the last 30 years and by huge margins. In the last election, they won by 25% in this riding. It's like downtown Toronto core, like very left leaning. And so last election, they won by 25% there. This time around, the Conservatives actually won the riding for the first time in over 30 years. Even in 2011, where, for the Canadian political science aficionados out there, the Liberal Party imploded at that time. And even then, they still won this riding by 10%. Now we're seeing this dynamic where this by-election was just basically just like a moment to see whether the polling was true or not on Trudeau. And it came out way worse than most people expected. I think the right was going to say it was a victory if we got close, but they actually won the riding. So that has triggered a lot of discussions about, okay, should Trudeau resign? Basically the election's like a year and a half away up here. And so it's a lot of similarities to what I'm seeing in the US happen with that debate, where it's like, we've been living in this theoretical world of these things occurring, but oh God, like this debate or this by-election is actually making it feel real now. And same thing that's happened in Europe recently with the rise of Marine Le Pen and all of that. And like things are starting to happen now, and we're seeing these shifts actually like meet the hard data. And that's going to be a really interesting trend for the next 2 years.
So here's maybe a hot take. I'm surprised that anyone was surprised about that debate. I
Exactly.
thought actually, I actually was just really surprised that anyone was surprised. I actually thought he did better than I was expecting, because frankly, I haven't heard him string together a coherent sentence. It was like, what did everyone think? Like, why is anyone surprised about this? I'm surprised people are surprised.
You're in your media is complete orthogonal to mainstream media.
I almost think that this is the best. This is like a not horrible outcome, because Trump's walking away from this super confident. His campaign's probably like, we can do no wrong. And that's when you make mistakes, right? It's like when you're too comfortable versus it's a heated race. And so I was like, have we been watching the same things for the last 6-12 months? Like, this is what everybody's been talking about. I just was like, what did you expect? I mean, it was sad to watch though. The beginning was like, wow.
Yeah, I'm also not. I'm not pro. I know I've said this a million times on this show. I would just love to see. Maybe this is just crazy, but like, I would just love to see like our version of JFK type deal, like a younger, highly energized. I don't know. That's what I would love to see. I know Quinn, you predicted Trump was going to be very unifying. Like maybe that's true. I still think he's a pretty divisive guy. I mean, but
yeah. That. I think everybody in the whole world agrees there's better candidates out of a 300 million population to choose from. But, you have to make a decision between two people.
Here, last little thing. Does this open up an avenue for RFK? Like, obviously he wasn't on the debate stage, but like, what happens if no one votes for Biden or no one votes for the new person? You get it spread apart, and then it's like a whole new race. I mean,
the Dems
conscientious objectors.
Malmgren said it might happen.
Both the Republicans and Democrats will have RFK. No, they will make sure he's not involved.
Yeah,
too much power.
All right, I'm gonna save this one.
All right, fellas. Good.
Have a good weekend.
Have a good run. Yeah, guys. Hey, happy 4th. Happy 4th. Yeah.
Happy Canada Day too on Monday.
And happy Canada Day. Yes. That's what I meant to say.
Wait, is that your Independence Day?
Yeah, that's when we got away from the British, sort of. I mean, we're still a constitutional monarchy, so not fully, but a little bit of freedom.
That's when the Canadians said, "Hey, could we have a little bit more freedom, please?"
Yeah,
I don't know why that came out Irish.
We'll still put you on your money, but yeah. Come on, buddy.
Come on, buddy. Hey, guy.
Hey, guy.
Not your guy, buddy.
And everything. Okay.
All right,
we'll end it there before we
Enjoy,
get in trouble.
Felix.
Thanks.
Yeah.